Thank you for tuning to the weekly review with me, Siti Nurabsai Juswa. Alright, moving on to some news that are hitting the global front right now in the United States of America. Based on the first estimates of gross domestic product, GDP, for its second quarter of 2012 released by the U.S. Commerce Department's Bureau of Economic Analysis, real GDP growth had slowed down and grew by 1.5%. Quarter-on-quarter annualized, sharply lower than the revised 2% quarter-on-quarter growth registered in the first quarter of this year. However, Affin investment bank Berhad Research said that this was slightly higher than the market expectations of 1.4%.
It said in its research note recently, the positive contribution to GDP in second quarter of 2012 was from private consumption, where contribution to real GDP growth was higher by 1.1 percentage points, albeit slower than 1.7% in the first quarter of 2012. Growth in consumer spending, which makes up 70% of the US economy, slowed from 2.4% quarter-on-quarter annualized growth in the first quarter of 2012 to 1.5% in the second quarter of 2012. Affin Research said growth in business investment, especially in equipment and software, also added 0.5 percentage points to the quarterly annualized growth, but this was also lower than 0.7 percentage points in one quarter 2012. The other GDP component supporting GDP growth was inventories, which contributed another 0.3 percentage points to growth, a turnaround from minus 0.4 percentage points in the first quarter of 2012. However, the research house said these positive contributions to growth were offset by a decline in net exports in the second quarter of 2012. With growth in imports rising more than exports during the quarter, the contribution from net exports was negative by a minus 0.3 percentage points in the second quarter of 2012, plus 0.1 percentage points in the first quarter of 2012. Affin Research said the contribution to real GDP growth from the government sector declined by minus 0.3 percentage points in the second quarter of 2012, albeit at a slower contraction rate of minus 0.6% in the first quarter of 2012. In line with market expectations, the first estimate of real GDP for the second quarter of 2012 reflected further slowdown in the US domestic conditions. The research house said slower second quarter of 2012 GDP seems consistent with the US Conference Board's leading economic indicators, LEI, which declined by minus 0.3% to 95.6 in June 2012, plus 0.4% in May 2012, the sharpest decline since September 2011. Affin Research expects US economic activities to slow further in the second half of 2012. US consumer spending is expected to contribute less significantly to GDP growth as the health of the US labor market conditions remain weak, especially considering the current high unemployment. The sharp slide of consumer sentiment index from the Thomson Reuters University of Michigan from 73.2 in June 2012 to 72.3 in July 2012 for the second straight month raises concern of whether there will be support to spur consumer spending further in the second half of 2012 and into 2013. Affin Research expects that if economic data in the months ahead weakened as a result of the European sovereign debt crisis, the Federal Open Market Committee, FOMC, of the US Federal Reserve, which will meet from 31st July to 1st August 2012, is expected to reiterate the view to take further monetary policy action to promote a US economic recovery.
Oh dear, another blow for the States. Hopefully they can stay strong enough though. So well that it seems that Europe is once more in the brink. Recently the region's debt crisis flared as fears increased that Spain would be the next in line for a government bailout. Wow, the crisis seems not to be getting anywhere or to resolve itself, or do they? Let's have a look.
The events unfurling in Greece is no surprise. It was noted that the new government's first major challenge from the re-election is to attempt to negotiate a better deal on its bailout. Greece has already failed to meet the list of existing conditions. Hence, the government is probably not expecting the Troika to agree to all its requests. If the changes fall way too short of the original demands, risks will arise. Should that happen, the public support for the Greece government can be expected to deteriorate, which will exacerbate by a further worsening in the economic outlook. This could turn out to be a summer of discontent for Greece. MIDF predicted that by first quarter 2013, Greece should leave the Eurozone. MIDF added that the only issue remaining is whether the exit will be orderly or disorderly, where an orderly exit will be positive as to avoid a Lehman's type of consequences.
Okay, now from the United States to Greece, now we bring you closer to home in Indonesia. Bank Mandiri first half of 2012 results beats expectations. Again, a positive sentiment here. So RHB Research Institute Sendirian Berhad, RHB Research said Mandiri reported a second quarter of 2012 net profit of 3,744 billion Indonesian rupiah. That was up 47.2% and 10% year-on-year and quarter-on-quarter respectively. So this brought its first half net profit of 7,147 billion rupiahs. That was 13% higher year-on-year and reached 51.6% higher and 52.3% of the research house's previous 2012 estimates and consensus forecast respectively. So Bank Mandiri earnings beat expectations considering the seasonal stronger second half.
RHB Research in its research note recently said Mandiri grew its loans by 26.6% year-on-year in line with system loan growth. Its micro-business continued to gain traction, growing 77.6% year-on-year from a low base. The research house said its corporate, commercial, consumer and small business loan book all registered healthy growth of 23.9%, 28.1%, 26.3% and 28.4% year-on-year respectively. Auto, credit card and mortgage loans rose 88.9%, 19.4% and 29.6% year-on-year respectively. RHB Research said it does not expect the new loan-to-value (L.T.V) rules on auto and property financing to have a major impact on Mandiri's business, given that its auto financing comprise mainly 4W loans, as the new L.T.V rules mainly impact 2W financing, while the average size of its mortgage loan is in excess of 400 million Indonesian rupiah. Deposits rose 15.3%, bringing loan-to-deposit ratio (LDR) to 83.4%, first quarter of 2012 at 80.7%. RHB Research said its current account and savings account (CASA) rose to 62.3% from 57.7% in the first half of 2011 that management attributes to Mandiri's strength in wholesale transaction banking and retail banking, in addition to solid transactional banking capabilities in cash management, forex and extensive electronic delivery channels. It said asset quality remained benign, with gross non-performing loan (NPL) improving to 2.07% from 2.42% in the first half of 2011. RHB Research raised its loan growth guidance for 2012 to 22 to 24% from 20 to 22%. RHB Research said the first half of 2012 net interest margin (NIMs) widened 4 basis points year-on-year to 5.24%, while NIM for the quarter reached 5.5% from 5.2% in the first quarter of 2012. This reflects improving returns for its recap bonds, an improved loan mix, lower costs of funds and higher LDR declined slightly to 5.03% during the quarter from 5.08% in the first quarter of 2011. RHB Research continues to consider options to pare down its recap bond holdings of 80.4 trillion rupiah to eliminate its vulnerability to fluctuating SPN yields. The research house adds, operating costs were well contained with Credit Information Report (CIR) at 43.6%. RHB Research 2012 to 2014 earnings estimates are raised by 9.1 to 13.2%. The research house further reiterated its outperform call on Mandiri and revised its fair value for the stock to 9,400 rupiah from 8,300 rupiah, derived from ascribing a target PER of 12.5 times from 14 times and rolling over our base year. RHB Research valuations remains undemanding considering the 2011 to 2014 profit compound annual growth rate CAGR of 18.9% and offer.
We're forecasting 2012 net profit to grow by 21.6% year on year, and 2013 to grow by 12%. So all in 2011 to 2014, the 3-year earnings CAGR is in the region of 19%. The new L.T.V rules on auto and property financing will not really have a significant slowdown drag on loans to the 4-wheel sector as well as on the 2-wheel sector. The impact on the 4-wheel loans is relatively muted in our opinion, because the buyer profile that is served by the banks that we cover, BCA and Danamon, is for loans which are of a relatively high dollar value. So the customer base can pretty much are able to come up with the higher down payments required. Now on the 2-wheel side, while there could be an impact, we think that the impact will be temporary in nature. There is a strong growth in the terms of the middle income class, the middle class in Indonesia, and we think that it will take about 6 months before the potential 2-wheel motorcycle buyers can save enough money to meet the higher down payment. So we think that even if there's a slowdown in terms of motorcycle loans in the second half, we think that it will be temporary in nature, and motorcycle loans will continue to grow strongly from 2013 onwards. In terms of the Indonesian economy is, we think it's in the early stages of a new growth cycle. The growth of the economy is very much driven by domestic factors. The key risks for the Indonesian banking sector stems from the external environment. As you know, the global economic environment remains relatively volatile. And if there is a disorderly breakup of the eurozone, and if the slowdown in China is steeper than expected, or if the slowdown in the US doesn't reverse course, then we could see some impact from capital flow reversals, or maybe even portfolio flow reversals. But that could have an impact on the investments into Indonesia, as well as have a downward impact on the value of the rupiah. But in any case, in the near term, for the foreseeable future, for the remainder of 2012, we think the Indonesian economy is in quite a sweet spot, given that much of the growth is domestically driven. Well, Bank Mandiri is the top pick of the 4 banks that we cover in Indonesia. Bank Mandiri started off as a corporate bank. But in recent years, it's made huge strides into the retail segment. It's expanded its electronic banking base. It's expanded his ATM and branch network, and it's made good traction into the micro lending segment in Indonesia. We think that the recent second quarter results for Bank Mandiri were very solid. It reported strong loan growth across all its major business segments, and the asset quality remains very good. And it reported good growth in deposits, with low cost CASA deposits rising to 62% at the end of the first half. That has helped to support its net interest margins. So overall, we think that Bank Mandiri has developed very strong earnings momentum, and given that second half earnings for the banks in Indonesia are seasonally stronger than the first half, we think that Bank Mandiri's earnings can continue to grow going forward. As I said earlier on, it started off as a corporate bank, but in recent years, it's made great strides breaking into the retail segment, and now it's got a very strong transactional banking franchise, and as seen by the strong growth in CASA deposits, where they are able to garner a lot of low cost current account and saving account deposits that has helped to sustain net interest margins for Bank Mandiri. We have an outperform call on Bank Mandiri with a fair value estimate of 9,400 rupiah. We think that the stock, like I said, is on a strong earnings momentum. Valuations are relatively undemanding. It trades at a very slight premium to the banking sector average. So we think that based on the earnings CAGR of 19% that the stock is offering, we think that the valuations are undemanding for a bank of Mandiri's quality.
Well, our neighbour now in Singapore, loans and advances continue to advance at an encouraging pace of 18.4% in June, little change compared to the growth of 19.2% year-on-year in May. So TA Securities Holdings Berhad Research, TA Research said, from a month ago, total loans eased to broaden by 1% after rising at a stronger pace of 2.7% month-on-month in May.
It said in its research note recently in June, loans were mostly driven by the Domestic Banking Unit, DBU, which advanced at a healthy pace of 1.7% month-on-month. The Asian Currency Unit, ACU, also improved, but by a marginal 0.1% month-on-month and 15.6% year-on-year. TA Securities said by segment, drawdown by businesses increased for a second consecutive month to grow by 0.9% month-on-month, although 3 out of 8 key business segments recorded sequential decline. The research house said only business services reported month-on-month contraction in May. Credit extended for general commerce stayed positive for the second straight month. Manufacturing led business loans, followed by general commerce and financial institutions. In the consumer segment, advances broadened for the 8th consecutive month, led by loans taken for personal uses and credit cards. Meanwhile, housing and bridging loans, which account for some 17% of total loans, advanced by a robust 1.8% month-on-month. Despite robust year-on-year advances in loans thus far, annualized year-to-date YTD loans growth appears to be well within TA Securities' industry growth forecast of between 11% and 12% for 2012, a steep slowdown as compared to 24.2% acceleration in 2011. For now, however, the research house said the pipeline of loans is robust and supportive of growth. That optimism is, however, clouded by growing global risks along with weak economic climate. The constant limits granted to total loans ratio remained unchanged at 1.6 times for the past 3 months, suggesting that the bank's credit wariness have not improved or deteriorated during the month. On the same note, TA Securities added, utilization rate dipped by another 90 basic points to 56.7% from 57.6% in May due to an 80 and 90 basis points reduction in utilization of limits granted to the business and consumer segments. On the mortgage market, TA Securities said growth in housing and bridging loans rose at a faster pace than expected. Mortgages accounted for around 17% of total industry loans and advances. TA Securities said, in addition to the measures imposed by the government last year, macro concerns saw banks easing the limits granted on a sequential basis for both owner-occupied and investment properties in the earlier part of the year. New housing loans limit granted has also fallen in the first quarter. However, the second quarter saw the limits granted for owner-occupied property and new housing loans jump 7.3% and 20.4% quarter-on-quarter. The research house believes this partly contributed to the recent hefty 33 basis points decline in average mortgage rates to 4.08% from 4.41% in April 2012. Further to that, TA Securities believe that banks are positive on Singapore's property market as asset loan-to-value (L.T.V) of 44% and steady non-performing loan (NPL) ratio of around 0.3%. Nevertheless, the research house noted that banks appear to be less optimistic on investment properties, which saw a marginal increase of only 0.2% in the second quarter. TA Securities also expects the low and stable interest rates environment to continue to be supportive of lending activities. YTD prime lending rate, higher purchase and mortgage rates stayed unchanged at 5.38%, 3.44% and 4.08%. Meanwhile, deposit rates also remained stable during the month with 3, 6 and 12 months fixed deposit (FD) rates at 0.14%, 0.19% and 0.3% respectively. TA Securities said total deposits slipped by a marginal 0.1% to 492.6 billion Singapore dollars from 493.1 billion dollars after recovering by 0.7% in May. Loan deposit (LD) ratio stood at 91.9% from 90.2% in the previous month. The research house noted that this is the upper band of the banking system's comfort level for LD ratio and see room for more aggressive expansion for deposits. According to management of respective banks, DBS, UOB and OCB's comfortable LD ratio range is between 80% and 90%. Elsewhere, TA Securities said the industry average liquidity ratio dipped by 50 basis points to 16% from 16.5% in May and 16.6% a year ago. The research house said asset quality deteriorated slightly during the quarter as the banking system's exposure in the special mention, substandard and doubtful categories paced up slightly by some 20, 2 and 4 basis points respectively. Similarly, industry's data on the credit card segment, such as rollover balances and the amount of bad debt written off, continued to be on a rising trend, with each jumping 14.8% and 20% year-on-year. TA Securities said the charge-off rate for credit cards is also higher at 4.6% in the second quarter 2012 versus 4.5% in the previous quarter, possibly indicating some strains in repayment in the consumer segment underpinned by subdued economic activities and rising inflationary pressures. However, the research house believes that the impact is not significant to the banking system, given that the credit card segment only makes up less than 1% of total loans. Overall, asset quality should remain intact on the back of the unexpected fall in unemployment rate last quarter. Despite the contraction in gross domestic product (GDP), TA Securities said that companies in the construction and manufacturing segments increased hiring. TA Securities are overweight on the Singapore banks. It said the system's fundamentals are intact and should remain resilient amid the potential headwinds. TA Securities further add favouring the Singapore banks, premised on their attractive valuations where stock prices are trading at average price to book value (PBV) of around 1.2 times against average 3-year return of equity (ROEs) of around 11.4%.
Specifically, denting their loan growth, I can think of 3 factors at this juncture. First of all, the macro factors such as slowdown in economic activities due to uncertainties in the external environment that could dampen their loans growth. Rising unemployment rate that could result in a loss of consumer spending, and that would not bode so well for the loans growth since close to 30% of total loans are from the consumer segment. Thirdly, if the government were to put in more tightening measures, especially for the property market, this could dampen demand for the sector. Okay, the three business segments that actually registered a sequential decline. One of it was business services, another one was transport and communications, and the third was agriculture, mining and quarrying. But this could be one-off because these segments actually registered growth in the previous month. So I think to really see a trend, we need to see a consistent sequential contraction before we can actually conclude whether there's a trend or not appearing.
From the US Conference Board's leading economic indicators back to the EU crisis and a taste of something closer to home, those are some of the headlines making news on the global front, served to you by the analysts themselves. So Weekly Review takes a short breather now. Be sure to send us your feedback on the show at weeklyreviewcapital@gmail.com or #weeklyreviewcapital on Twitter. So don't switch that channel just yet. We'll be right back after these messages. Stay tuned with us.